So for a basic consumer, when I'm a or not a loan officer, I'm a buyer. I'm going to buy a house. I've got a loan officer working. They're working through Veritas. So they're basically coming to you and say, Steve, what price can I get for my borrower for this loan?
Yes, we set rates. I mean, every single morning and through the day. And back in the old days, it was we set rates by paper and fax machines and everything like that. And today, the rates are electronically posted to loan officers, who then quote those rates to the borrower.
Nice. Very interesting. So I'm getting a picture here in your mind, and obviously I do have some insight into the industry. I'll bet you're looking at a screen to your left or right now that has a ticker symbol of what the mortgage-backed securities are doing on a point-by-point basis.
All day long.
So as if I was sitting here looking at my stock go up and down with the Dow Jones or the S&P, you're watching mortgage-backed securities tick up, tick down, tick up, tick down.
The exact same thing. You're correct.
Well, so then great. So let's say this morning it started right here. By the afternoon, it's right here. It moved up some, or maybe it even moved down. How do you know which price to actually give to the consumer if it's always moving like that?
You know what? You're looking at, I mean, the cost through every channel is to what it costs you to create the loan, and then you just back into that number. So, and that could change. And what it's based on is you base it on a security price, and that price, those rates go out as the security price gets better or worse. Those rates get better or worse, slightly. There have been really large exaggerations on days, more than the worst days are maybe worse than a point in rate. That is, in the 40 years, happened like once or twice. Okay.
So
But
from what I'm hearing you saying, it's if it's only moved about a point in rate one time in about 40 years, it's kind of insulated a little bit then, and we have a little bit of control in the market itself as to what rates do. So for example, let's just say today's rate was a 6%. What would make it jump to a 7% other than Russia or China invading the United States?
you're going to have two things. You're going to have real news, economic news, and you're going to have fear, of something that may drive it one way or another. But it is really driven traditionally by economic news as to, you know, um, just like your stocks. You know what? If you have a great earnings on a stock, you see that stock go up. You're going to see the same thing in mortgage-backed securities. When loan officers will call and say, "Hey, I've got a borrower sitting on the fence. I don't know which way this is going to go. Join the club." I mean, the market does move. Uh, in certain, it'll move in tranches, and you'll see it, a high and a low, and when it breaks out of one and into the other, the market either improves or gets worse, and then you're in that next trading range, and it stays in that trading range fairly frequently, and you have 60-day or 90-day or 120-day moving average on different securities that create the trading range.